So Keith, today we're going to be focusing on project structuring and the basics around the CAP agreement. But first, do you want to tell us a bit about yourself and how your experience relates to DPC?
Sure. So I'm Keith Beattie. I'm one of the partners in the projects team here at Burgess Salmon. I have over 25 years experience of advising sponsors, procuring authorities, funders and contractors on a wide range of infrastructure projects. And that covers defence, social infrastructure, transport and energy. And directly relevant to what we're talking about today, we're currently advising on a direct procurement for consumers project in the water industry.
So lots of really relevant experience. So given DPC is relatively new, what can we foresee, what can we say about expectations around the CAP agreement and the structure of the overall scheme?
Yeah, sure. DPC is new, but it is based on, I suppose, existing social and wider infrastructure structuring and risk allocation. So whilst it's new, we're not starting from a blank sheet of paper. It's going to be the default model for delivering projects in the water industry with a value of over £200 million. And it will draw heavily, we think, on experience from Private Finance Initiative or PFI, and potentially newer models such as the Welsh Government's mutual investment model. Interestingly, Ofwat have published some high-level risk allocation, but they haven't published definitive project documentation, so it leaves flexibility for the market and flexibility for the water companies in terms of how they tailor their agreements and tailor the structure of the project. The CAP agreement is the core contract, really, and in old PFI terminology, it was the project agreement, and it's the agreement between the water company and its main contractor or the competitively appointed provider, under which they tender the design, construction, financing, operation and maintenance of the project. So effectively that's the water company outsourcing delivery of the project. And that's a critical way to look at it, in that the payments to the CAP only start once the project is operational. So until that time, it's for the CAP and its funders, both equity and debt, to take effectively the construction risk. So that's going to be one of the key challenges, in that what is already a complex procurement for a construction project then has the additional layers of needing to apply debt, equity and wider structuring in a regulatory environment on top of it. So that, I think, is the challenge that lies ahead, but one that should be familiar to the infrastructure market based on PFI.
So based on your broad experience, obviously, of PFI and project finance in other sectors, and if we really drill down into what are the key issues, what are the challenges for the water companies and then for the various parties that will make up a CAP entity?
Sure. I think it will be similar to PFI in that whilst there are some fundamental principles that go to the heart of the risk allocation, critically, they need to be tailored both for the sector and for the specific project. So PFI was used for a wide range of infrastructure projects, from prisons to schools to military satellites, but it's not a case of one size fits all. And I think that's critically important when we look to structure new DPC projects. The starting point will always be the requirement, and having a clear requirement and clear acceptance criteria, and not relying on the market to define the requirement. And that's certainly something that all stakeholders, whether it's the procuring water companies, the CAP, sponsors, funders, everyone is going to need that clarity of risk allocation. It's going to involve and require a considerable amount of resource on the part of the water companies. These projects of themselves are major construction projects, and the risk allocation and the time to let the construction contract would be a big project in itself. And when one then layers on equity participation, funders and a new structure, I think the market shouldn't underestimate the amount of time and complexity it will need to launch the project. All that said, the expectation is that by coming up with a structure that the market then becomes familiar with, through competing the delivery of the projects, ultimately the objective of DPC is to deliver lower cost to consumer. we're all looking on with interest to see how successful that can be. PFI got a bad rap, certainly in the press, but I think it's fair to say that it delivered a lot of infrastructure at a time when the government didn't have the capital to commit to that infrastructure. And that, certainly if one looks at the scale of the opportunity within the water industry, I think we're looking at a structure that can unlock a huge amount of investment and critically successful delivery of projects that the market and the water infrastructure really needs.
Mm-hmm. So key challenge, what are we thinking?
I think the key challenge is around clarity of that risk allocation and early engagement with the funders, in that the contractors, certainly doing the construction work, ultimately they'll understand what they're doing. It's what their core business does. I think the key challenge will be early engagement with the funding market, both debt and equity, to effectively test whether the risk allocation makes this structure deliverable. And I think it's going to be interesting times ahead, in that everyone is going to be looking at this to see, does the model work? Because the wider infrastructure market is looking for the successor to PFI, and maybe DPC could be a model that could be rolled out across the wider infrastructure market.
Really interesting. So lots of experience and lots to draw on in terms of the wider CAP arrangement, wider CAP agreements, and how we take things forward.
Absolutely.